everyone. It's 5 past time. Welcome to today's workshop, and super excited to have everyone on the call today. My name is Kingsley, and I'll be your host for today. The topic before us today, it's quite an interesting one, structuring share classes for the next fundraising round. That's super interesting. And just before I hand over to the next person, I'd just like to give a brief introduction about Raise. And so Raise is the go-to platform for simplifying the fundraising process for founders and their investors. We do this through the use of digital tools. And some of those tools you'll be seeing on this webinar today. And also feel free to share where you're connecting from in any part of the world. We'd like to know where you're connecting from. At this point, I'd like to hand over to Sam as she takes it up from here to take us through an amazing journey of learning. Sam, over to you, please.
Thank you, Kingsley. Hi, everyone. My name is Samantha. I'm Customer Success Lead at Raise, and I work together with the legal onboarding team to support in the cap table onboarding of our users on the Raise platform. Once again, thank you for taking the time, and we are excited to have you here. So before we start, I'm going to give the opportunity to the rest of the team to introduce themselves.
Thanks, Sam. My name is Patience Agumba. I'm a legal engineer at Raise. I assist clients to manage their tables pre and post their fundraising rounds. Thank you. It's a pleasure to have you all here.
Ozzy?
Hi, everyone. Good afternoon. Well, it's still morning here, but good day to wherever you are in the world. My name is Ozzy. I'm the B2C lead at Raise, and I'm happy to be here to join you on this knowledge sharing session. I hope we have a wonderful time.
Great. Thank you, everyone. So in today's session, we're going to be talking about structuring share classes for your next round. So this session is broken down into 2 agenda points. So we will move to the next slide, Kingsley. Yes, as you're waiting for Kingsley, for us to move to the next slide. Yes, thank you, Kingsley. Yes, today's session is going to be talking about the different share class structures at the different fundraising rounds. And we're going to take you through how this is set up on the cap table features on the Raise platform. And then we're going to get into an interesting session also talking about employee stock options. So moving to the next slide, we'll start off by introducing the cap table. So the cap table gives a snapshot of the equity capitalization of a company. So basically what this means is that the cap table shows who owns what in the company today, and that's between the founders, investors, and the employees. So keeping your cap table clean is really important. So a clean cap table means that you're investor ready. And before you fundraise, having your cap table clean also makes sure that you're able to model out how your prospective dilution would look like. And then as well, having it clean post-round also makes sure that you sort of understand these new people who are added to your cap table and how this affects your ownership in the company. So we'll move to the next slide. Whenever we're talking about the cap table, there are so many terminologies that are used. So we're going to take a few minutes to define what some of these terminologies mean. So the first one is equity, which refers to the company ownership. And as an employee, it's really important to understand equity. This can be given as a form of compensation to you by your employer. And we are going to talk a bit more about this during the employee stock option segment of the webinar. Then we have the authorized shares. So this refers to the maximum amount of shares a company is allowed to legally issue based off of its corporate charter. So these shares are usually set up when a company is initially being incorporated and are not owned by anyone. The corporate charter, however, issues a subset of these shares to the founders. Then we have the issued shares. So this refers to shares that have actually been issued to people, and then they do not exceed the authorized shares. So move to the next slide and talk about more definitions. And we have the outstanding shares. This refers to the number of shares that are owned by the shareholders. So the outstanding shares can be equal to or less than the authorized shares. Then we have the share price, which refers to the highest amount or the lowest amount a share can be bought for. Then we have the shareholder. This refers to someone who owns equity in a company. Then we have investor, which refers to someone who commits money into a company in exchange of equity. So now that we are done with defining the complex terms used whenever we're discussing the cap table, we'll talk about the share class structures that are different at different stages of your round. And then we're also going to go through a demo to show you how this is set up on the Raise platform. So moving to the next slide. So during the earlier stage, companies usually have their share structure set as common share class or the early convertible instruments. So the common share class, also referred to as the ordinary shares, are a security that represents ownership. So these are usually issued to businesses or investors as proof that they have bought into a company. So common shares usually set the basic foundation of your cap table, and then also how the future share structures would look like. Then we have the early convertible instruments. So when companies are fundraising during the pre-seed stage, they might opt to issue SAFEs and convertible debts to investors. Then at a later stage, so that's during the seed or series A. So we'll move to the next slide, Kingsley. We have the preferred share class structures. So the preferred share class is different from the common share class. So investors who come in during the earlier stage of the fundraising convert to preferred shareholders. So with this share class, they're able to enjoy certain rights. So for example, dividend payments. So we're going to get into a brief demo where Patience is going to show us how these share structures are set up on the Raise Plus platform. Please take it away, Patience.
Thank you, Sam. I'll be sharing the screen now. So as Sam has just stated, we have different share classes for different stages of a company. And at the early stages of a company, we tend to have a simplistic or a more simple cap table structure. And that is what we can see here. We have the common shares, and then as the company continues to progress, some of the convertible debts or notes that it issues out to investors convert to preferred shares, or once again common shares. And the difference between these two share classes is that there are seniority rights that are allocated to the preferred shares, and this means that the holders under this specific share class have more preferential rights when it comes to dividends or profits that the company attains over the period of its existence. So as you can see here, we have a representation of the convertible and debt instruments, that is convertible debts or SAFEs or a debt only. And what a debt only means is that when a company is fundraising, it will receive a loan which will be repaid at an earlier date. But the difference between that and a convertible note or a SAFE is that the SAFE and note, depending on the terms that are agreed upon in the investor's agreement, they convert to either a preferred share or a common share class. We will also be talking about ESOPs, which a company will issue out to its employees, and we will delve more deeper into that in the next segment of our workshop. Thank you. Kingsley, you can take it away.
All right, Patience, thank you. Very interesting sections we have ahead. But at this point in time, I'd like us to quickly take a very short break as we go through some very fun facts about the tech ecosystem. You would see some very, very interesting things in the very short moment now. All right. Yes. So I hope we can all see my screen. So it's verified that over 90% of the world's currency is actually digital. Like it's there I found this, it was mind blowing. Then next also, we all know Samsung, like the electronics giant, you know, it started off as a grocery store back in March 1938, and in the 1960s, Samsung veered into electronics industry. So whenever you see anyone holding a Samsung phone, just know that they are quite lucky to do that because it was actually a grocery store. Then next would be YouTube. So our very own popular YouTube was actually registered on the 14th of February 2005 as, you know, was registered with the site intention of being a dating site. So you could just go on this website, that's youtube.com, and upload videos of your dream partner and a whole lot of things. But then it became what it is today because they found out that people were not uploading their videos, and it was quite a challenge. They had to open it for people to upload all kinds of video. And you must agree with me that whatever it is you're looking for, once you go on YouTube, you'll definitely find that. But don't forget, it was initially a dating site. Next also, this is great. So the internet speed at NASA is actually 91 gigabytes per second. Like that's quite interesting. And so every new month, there's over 6,000 new computer viruses, and this comes in forms of 90% of them come in form of email and malware. And lastly, so this is real, like very, 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 and I'm sure you agree with me. On an average, people read 10% slower from a screen than on paper. Like I've confirmed this as well. All right, so we are saying to everyone, don't stop innovating, keep creating. And at this point, we'll go back to our webinar. I'd like to hand over to Patience to take it up from here. Patience, over to you, please.
Kingsley, we're not able to see your screen.
Oh, Jesus, my God. Sorry about that. I guess it's a technical issue. So I'd like to restart. So is it coming up now?
We still can't see it. Let's just give a few moments for this.
All
Maybe
right.
try disconnecting and connecting your screen again.
Okay, thank you. Okay, it should come up now. Are we able to see it now?
Yes, we can.
Okay, thank you so much. So I'd like to hand over to Patience now, so she can take us on the next phase.
Thank you, Kingsley. So in this segment of our workshop, I'll basically be taking you through what ESOPs are, giving you a simple overview of how they work and the process of vesting, and then also how employees exercise their rights under an ESOP. So I'll be sharing my screen for that. Sorry, I'll be sharing it during the demo, Kingsley. You can continue sharing the files.
All right. Come up now.
Great. So what are ESOPs exactly? We know that stock options are incentives that employees give to their employees so as to encourage them to stay longer at a company, or also to show them that they are a valued asset to the company. And some of these benefits can be in the form of salary, or a house allowance, or more. Next slide, Kingsley. When we're talking about vesting, this is, so a company has issued out stock options to you as an employee, and now you want to understand how you can earn that asset. So vesting is basically the process of through which you as an employee earns your right to buy the shares which the company has issued to you as an employee. And we have different types of vesting, and they can either be time-based, they can be milestone-based, or they can be a hybrid, which is a mixture of a time-based vesting or a milestone-based vesting. And so the first example that we have here is immediate vesting. And immediate vesting is basically a time-based type of a vesting, which means that there's no time period to leverage the benefits. As an employee, you immediately, the company gives you those shares, you earn them, you earn the right to ownership of those shares. The next type of vesting is cliff vesting, which is a hybrid type of a vesting. So it combines the time and the milestone nature of a vesting, such that there's a certain milestone that has to be achieved, during which a lump sum benefit is received at a specific date. So how this will work is, let's say in terms, you have a 3-year cliff vesting, and as an employee, you wouldn't receive any shares or any benefits until you reach the 3-year employment, or the 3-year milestone that has been set according to the agreement. The other type of vesting is graded vesting, and this is a time-based vesting whereby the individual receives incremental ownership. And an illustration of this is basically, you have a time span that has been set according to the agreement, and within that agreement, during the first year, it's agreed that you will receive 10% ownership of the shares, and then it will continue to increase gradually until you receive the 100% ownership. So this can work out in the following nature. The first year you get 10%, the second year you get 25, the third year you get 45, and then finally you receive 100% ownership of those shares. Then we have the accelerated vesting, which is a milestone-based type of a vesting. And the milestone here will be either the company is sold or a company goes through a merger and an acquisition, in which case you as an employee receive first rights to sell or exercise those shares. Thank you, Kingsley. We can move on to the next slide. So let's look at an illustration of how this vesting would actually occur. So on 1st January 2021, We Are You company awards employee A 10,000 ESOPs, but these shares don't vest to the employee immediately. Instead, the company opts for a vesting schedule of 4 years with a 1-year cliff of 25% to these shares. So at this point, I'll share my screen so that we can see how that illustration works. Thank you. So let's first add the employee to this specific company, and we're calling this employee A. And we'll add the respective details to that employee. And then once we've added this employee, we're able to then assign to them the specific ESOPs. So in our cap table, we already have the employee stock options. So we will add that shareholder. And the share class is the ESOPs, employee stock options. As we've discussed, this is an incentive-based type of an option, and they're not paying any amount because we already have a cliff vesting assigned to them. And the company issued out the shares to them on January 1st, 2021. So we've successfully added the shareholder. So now let's view them under the class and see what it is that we've added. And here they are, employee A, 10,000 shares. So let's now go ahead and create the vesting schedule. So according to the illustration, we will name this vesting schedule VRU, vesting. And we have a cliff percentage of 25, and the cliff period is 12 months. And 36 months will be the vesting period for those shares. And the reason why is because, cumulatively speaking, the 12 cliff period and the vesting period for 36 months adds up to 48 months, which is 4 years, according to our illustration. And the vesting, we can choose for it to start on the date set according to the agreement and according to our illustration. So now that we've created that vesting schedule, let's assign a holder to that vesting schedule. And we're interested in employee A. And now that we've added that, the vesting schedule is VRU vesting, and the start date would be January 2021, the 1st. So once we've assigned that vesting schedule, we're then able to see the calculations of the ownership that they will get in the company, and the start date and when it will end. So for a clearer illustration of this, we'll look at the employees' vesting details so that we can understand and see how the vesting calculates over the period of time. So when we look at the vesting schedule here, we can see that the start date is January 1st, 2021, and it will end February 1st, 2025. So the calculation of this is basically that we had a cliff period of 12 months at 25%, which meant 25% of the 10,000 shares, this employee will receive 2,500 shares after the first year. So that is what we can see here. On January 1st, 2022, a year later, he receives 2,500 shares. Then over the next 36 months, we can see that the shares continue to vest. They continue to vest up until January 1st, 2025, and he gets the 10,000 shares fully vested upon him, at which time he can now choose to exercise his rights by either buying those shares and acquiring them or selling them to the company. Thank you. I hope that is clear. Any questions that you might have, just share them with us on the chat box.
All right, Patience, thank you so much for that. I'll go back again to the presentation and take it over. Yes. Okay, hey there.
So yeah, now we've looked at how the vesting works. So the next question is, as an employee, you're wondering, these shares have been issued to me, so how do I get to enjoy them? How do I get to get the best out of it? And so the exercise is basically you purchasing those shares at a set price, and this is agreed in the agreement or agreed at a later date. So as an employee, you can either opt to exercise your right to purchase before those shares fully vest or after they fully vest. So for an example is the illustration we just had, whereby 25% has already vested upon you as an employee. You can choose to exercise and buy that 25% share, or you can wait until all the shares are fully vested upon you for you to buy them and exercise your right to purchase from the company. The other type of way in which you can exercise is after termination. As an employee, obviously the company will give you a set term of employment. So once that ends, you can choose to either exercise your options within those 3 months of your termination as an employee, and failure to which those shares will go back to the company. So this is a very crucial thing that you need to keep in mind, that upon termination of your employment by the organization, you need to exercise your right within 3 months. Then finally, we have an early exercise, which is similar to what we had just talked about, which is the immediate vesting or the accelerated vesting. In which situation you as an individual or employee will get the right to buy or sell those shares under the terms of that option. And that's it. Thank you, Kingsley. I leave it to Sam to take over.
Right. Thank you, Patience. So we've talked about the share structures and then also talked about the employee stock option. And I'm sure you're wondering, how do we value these options? So we'll move to the next slide. So we're about to get into a very interesting session where we're going to have a math session where Fane is going to take us on how to do these calculations. So basically, the value of the stock is dependent on the performance of the company, right? So if your performance is low, then it means the value will also be low, and then vice versa. So Fane will show us in details how we can do this calculations.
Thank you so much. I'm sharing my screen. I hope everyone can hear me clearly.
Yes, we can hear you, Fane, but not too clearly.
Oh, okay. What about now?
Yeah, now it's better.
Okay, awesome. Thank you. So we come to the second part of the illustration. So we came up with a very simple example for us to understand the basic understanding of how to exercise your shares. So I won't be touching on taxation or any nitty-gritties. If you have any questions, just feel free to type in the chat box. So a company called Made has a total of 1 million shares on their cap table. So these founders opted to set aside 500,000 shares during the investor round that they will reserve for their employees. So in 2021, the company needed was done for a valuation, and it came to a total of 2 million USD. So first thing is that in 2021, an employee was issued with 10,000 options by the company. So in order for us to understand how exactly the exercising will come in, we have to figure out the value of the shares in the year in which the company issued these options to the employee. And then secondly, we will look at how much the amount that this employee will pay for these 10,000 shares if they want to exercise it. So the first part is finding out the value of each share, and we'll look at the formula. So for each price per share, we look at the total company valuation divided by the total number of shares in the company. So we have the company valuation being at 2 million. and our total number of shares being at 1 million. So that means we will divide 2 million USD, but the total valuation divided by the total number of shares, which will give us $2. So this is the price per share in the year of 2021. So if this holder, this employee wants to exercise their shares, they will buy it at a strike price. What is a strike price? So the strike price is the initial value of this share by the time that they were being issued to by the company. So that means that we will take the holder's total number of shares multiplied by the value of each share in 2021. So that means we will take that 10,000 shares of the employee multiplied by the $2, which will give us a total of 20,000 USD. So this is the amount at which these options will be exercised by the holder or the employee. So in an instance whereby there is an exit that happens in this company. So in this scenario, we came up with an exit in 2027 in the form of an acquisition. So the company does a valuation at this time, and it is valued at 20 million USD. And in the instance whereby we haven't even increased the shareholding over time, we'll still stick to the value of 1 million. So the question here is, at the time of this acquisition in 2027, how much did this holder acquire in profit from the exit? So we will go back to the first two steps that we did. So we'll have to first calculate the value of this share in 2027, and we'll use the initial formula that we did to get the price per share, which was the total valuation of the company in 2027, which is 20 million USD, divided by the total number of shares in this company, which is in this instance still 1 million. So when you divide that, we'll get the value as 20 USD. So the second part of this is that we want to get the value of, we want to have an idea of how much this employee will receive in 2027. So that means we'll multiply the 10,000 shares or options that they have multiplied by the current value of each share, which is 20 USD. So at the time of the exit, this employee will get $200,000 in total for all their shares. So to get their profits, we'll have to subtract the amount that they're getting in 2027 minus the initial amount that they paid for those shares. So that means we'll take 200,000 USD and minus the amount that they had paid for the shares in the beginning. So this will give us a total of 180 USD, and this is the profit that the employee or the holder will get. So this comes to the end of the illustration. Do you have any questions? If I wasn't clear, please feel free to type in on the chat box. Thank you. Back to you.
All right, Fane, thank you so much. At this point, I'll take us back to where Fane is going to complete her next part of. So my screen will come up now and will take us back to the presentation. Just a second, please. All right, so we'll be going to advantages. All right, Fane.
Okay, so thank you, Kingsley. Just overzealous session. So the advantages of these stocks are the first one is tax advantages, and also we have that the ESOPs act as a motivation to the employees since they are milestone based. We also highlighted that they are a source of future investments in other startups ecosystem. So let's say you have gotten a bit, in that instance whereby the holder has a profit of 180,000 USD and they opt to seek to invest in other startups. So that ensures that the profits, the money still rotates in the ecosystem. And lastly, as an advantage to the company, is the retainment of talent. So we know that in the beginning, when you're setting up these ESOPs, you have to set different categories at which you're going to give employees based on their capabilities and also like their milestones, so that make sure that you retain the talent that is needed in your company for a certain period of time. Yes, back to you.
All right, thanks. At this point, we'll be open to questions. You could just feel free to unmute yourself and share your question, or kindly use the question and answer box question. Okay, we have one from Vinod. It says, when we have an existing share, okay, that has been answered already. Yeah, so do we have questions at this point?
Kingsley, maybe you can just read the question aloud again, and if the question has been answered, you can read out the answer just so that it's a bit clearer and everyone else in the audience section can, yeah.
All right. Okay. So the very first question we had today, it says, when we have an existing shareholder and are looking for an equity investor, but there is confirmation of ESOPs, but no handover yet, how do we ensure that this becomes part of the contract stroke deal, and who should offer the shares? More context to this is this the existing shareholder or the new equity investor, or partly shared by both? And so the answer basically from our legal engineer is, it will be prudent to understand which shares in your pool have not been issued out. Very important. Also signing a board resolution on the ESOPs, and also creating a proper stock option plan agreement, which will help in monitoring the shares and what is going where. Very, very important. And also, Vinod also asked another question. Would one of the panelists be able to give more insights into what it means by the statement phantom shares, and what are the benefits or backdraws? Okay, so phantom stock options are an example of stock options which are not in existence until they fully vest upon the employee stroke holder. They are more advisable due to their tax advantages as opposed to the normal ESOPs, as they will only be taxed once fully vested. Thank you. Another question. Okay, saying, how can we properly value our company?
So someone from our team will be handling the answer to this question. Faye, maybe would you be able to take this question on how to properly value a company? Faye?
Thank you, Ozzy. I'll answer that. For you to know the proper value of your company, or to ensure that you're valuing your company accurately, you need to do a proper assessment of your financials, also a proper assessment of the equity that you have already created in the company and what it is that you're issuing. So on the Raise platform, we're able to do a valuation for you. There are a couple of questions that we take the founder through to just understand what is the position of the company. That is because it's very important. You don't want to be in a situation whereby you've undervalued your company or overvalued it. So you want to have a proper understanding of just how much it is your company is actually worth. So to do that, your financials are assessed against the equity that you have. And I believe Sam or Tina can add more on this. Thank you.
Thanks, Patience. I believe you've covered it. I hope we've managed to answer your question.
Just to throw a bit more light on how to value a company, we actually organized a workshop previously on this, and whoever actually asked this question, if you could share your email address in the chat section, I could after the workshop session email you a recording of that workshop on valuations. It was actually a very, very detailed workshop. We did share methodologies that are used, and I'm happy to email you the link to that recording just so you can get it. Also, anyone else would also like to get a link to that recording, just drop your email and then I'll share that with you. Yes, thank you.
All right, thank you so much, Ozichi. Thank you, Sam, and Patience for making that very clear. I'm sure Panshak Akinlaja has been able to get more insight into the question he has asked. At this point, I'd like to find out, okay, there's no question anymore. Any final question before we go to the next phase? All right. So the box is still there. The question and answer box is still there, just in case something comes up. You can feel free to drop that. Thank you. At this point, I would like to welcome Ozichi to take us through the final round of this workshop today. Ozi, over to you, please.
I think someone said they had one more question. I did see that in the chat. Could you please raise your hand if you still have one more, if you have one more question? I thought I saw someone say that they had a question before. Okay, so Winston, right? So I'm just going to unmute you. I've unmuted you. You can go ahead and speak.
Yeah, no, that's definitely, I think, more expedient. Thanks for doing that. So the question I had was with regards to especially local Kenyan staff having to pay the strike price for their shares. Say they join a company at seed or beyond. Valuation of the company is say at $10 million plus. Oftentimes, I would imagine that by definition, that person would likely be totally outpriced from being able to acquire shares. I mean, like in the Kenyan market, I mean, is that scenario that you illustrated usually the typical one, or is it usually the case that that an individual would not have to buy shares themselves? They would just be, issued the shares according to Cliff Investing. Just want to confirm, were you guys able to hear me?
Yes, we were, Winston. Thank you. Fane?
So first thing is that the illustration that I gave is not a blanket solution to everything. So we have a situation whereby we issue options to an employee, but then you attach a vesting to it. So that means that the strike price will still be at either an agreed price with the company according to the agreement, which is a set strike price for each employee. For each employee is going to be about that vesting schedule. Or just according to the agreement. Does that clarify, or does it bring more questions? And if so, please feel free to ask them.
I'm so sorry. I mean, I was able to get a little bit of that, but I can follow up offline. I don't want to derail the presentation. Thank you though for your answer.
Patience, maybe Fane, maybe you can just type the answer in the chat section because your audio was a bit muffled at some point. I also struggled to hear you at some point. So if you could just type the answer within the chat, and so Winston can be able to make reference to it afterwards. Thank you.
All right, so Ozi, over to you as we go to the next slide. Ozi, on mute.
Oh, I'm so sorry. I was saying that please, anyone, if you still have any more questions, please feel free to type in your questions within the Q&A chat box. We still have a bit of time for this workshop session, and we'll just move on to the next section of the workshop. Okay. So now we're going to be talking a bit about cap tables at this point. Now, we already know that maintaining cap tables can be a bit tricky, and it can also be painful because firstly, you have to manage multiple spreadsheets. You have to also pay, you also need to pay legal fees. And in addition to that, also you also need to be able to have accurate information and always update your cap table. So it's a lot of work that goes into having a clean cap table. This is why at Raise, we've made it our business to ensure that we simplify this process for our clients, right? You can basically raise money. You basically cannot raise money without having a clean cap table. And I'll explain why. Next slide, please. Next slide. Kingsley. Okay. So now, most startups actually wait until it's too late to fix this cap table issue. Now, we're not saying that everyone has a faulty cap table. What we're saying is that it is possible to have a clean cap table, a cap table that's always up to date, because your cap table is extremely important for making financial decisions for your startup. It's also extremely important for you when you're about to fundraise. This is because your cap table is basically the source of truth or source of information that you use to make financial decisions for your company. And if you wait until it's too late to have a clean cap table, you could end up losing control of your company. You could also end up paying expensive legal fees to fix these issues. And also, you could also slow down the process of raising money and your investment process. Now, how do we avert this problem? Next slide. We can do this by automating our cap table. And one major way you can do this is by using the Raise platform. Now, to do this, and how it basically works on our platform is the Raise platform supercharges your cap table. This basically means that Raise saves you time and money by automating your cap table for you. Basically, what this means is, firstly, with an automated cap table, it means whenever a change occurs to your cap table, this will automatically be updated on your cap table. Meaning, if you have a new shareholder, it will be updated. If you want to create a new share class, it will be updated and automatically calculated for you by the platform. Because again, that's what the platform was built for. In addition to that, you'll also be able to distribute digital certificates to members of your cap table. This basically means that every single member, every single shareholder within your cap table will have a certificate that lets them know, first, the amount of shares they have within your cap table, the percentage of ownership they have, and of course, the vesting schedules and terms associated with these shares. In addition to that, you'll also be able to automate your due diligence, meaning will basically be provide you with an automated legal diligence that will make it possible for you to become investment ready, basically preparing you for negotiations with investors. Also, you'll be able to generate evaluation reports for your company. So this is also making reference to the previous question that was asked about valuations. If you want to know the value of your company, you can get a data-driven report directly from the Raise platform. And lastly, you'll also be able to track employee stock vesting. So let's move to the next slide. Now, one other thing that we've been able to do is we've put together a Founders Toolkit. And basically what this Founders Toolkit does is, firstly, it provides, it helps you to raise your round faster by providing you with a clean diligence checklist for your round, meaning you have a checklist that will give you information on all the things you need to do before you go into negotiations with investor. You also have access to free contracts, so details like financing agreements, founder templates, stock options, and more great documents for you to use and save money on. So the toolkit basically is, you can think of it as a founder's a founder's toolkit that basically helps you to prepare for your fundraising. And lastly, all these documents are built specifically for different countries, right? So all African countries. So if you do have your incorporation in an African country, you'll be 100% covered. If you have an incorporation outside of Africa, so for instance, if you're incorporated in the US, in Canada, or in the UK, these the documents provided in the toolkit will also be applicable to you. Next slide. So lastly, in order for you to take a step further and to ensure you have a clean cap table, you're closing your round faster, you're planning ahead of time for your future fundraising, and you're having an accurate evaluation report, you can go live on the Raise platform in minutes. We have a team on standby to provide you with all the support you need. You also have access to tools that will help you build your company data and sync your data on the Raise platform. You can get started by going to our website, getraise.io. This onboarding process is seamless and quick. If you'd also need to go ahead and book a call with us just to get more understanding on how the Raise platform works, we'll be sharing the link to schedule a call with us in the chat section. And in addition to that, we have a team, our customer success team on standby to provide you with all the support you need. So my colleague has already shared the link to schedule a call with us. And in addition to that, we would really appreciate it if you can give us feedback on your experience with this workshop. The reason is we'd like to know firsthand from the attendees of this workshop on how we can improve our workshop events to provide you with a better experience, to give you more knowledge. You can also leave extra information on the topic you'd like us to treat next. Thank you so much for joining us for this workshop session. I'll just hand over to Kingsley now.
All right. Thank you, Zichi, for taking us through that very, very insightful walkthrough on the Raise platform. And then again, for as many of us that are here, we'd like to say thank you for taking out the time. And don't forget that we have the link on the chat box where you can feel free to schedule a call with us, and we're able to help you more on things that are happening in the ecosystem and how you can fundraise super fast on the Raise platform. I'd like to say thank you to everyone for joining us at this point. Wherever you are in any part of the world, thank you so much and have a great day. Please enjoy the rest of the day. And don't forget to fill the feedback form. Very, very, very important. We look forward to meeting you again. And lastly, this is the giveaway. So don't forget that you can create your account on getraise.io and you can sign up the free plan and walk through most of those things that you've seen on the workshop, and lay your hands on them. And if you have any challenge, which you would hardly find, you can always reach out to us. So thank you so much, everyone. And please enjoy the rest of your day. Bye from here. Bye from the Raise team. Bye.
Before we drop off, Olani has requested that we just go through we basically identify ourselves because we didn't add names. Our apologies for that. So we'll just go over our introductions again so you can meet the members of the team. So speaking now, my name is Ozi. I'm the business to customer lead. I'll just hand over to my colleagues to introduce themselves again.
Thanks, Ozichi. Hi, everyone. My name is Samantha. I'm customer success lead at Raise. Thank you all so much for your time.
My name is Patience. I am a legal engineer at Raise. Thank you as well for your time.
Hi, everyone. I'm King Kioma, the onboarding lead at Raise. Thank you for the session.
All right, and thank you everyone again. My name is Kingsley. I lead the business to business team at Raise. It's a pleasure meeting everyone today. Thank you all.
So just to answer Alani's question, he's asked another question. So there's actually no cost to signing up on the platform. The platform is free for your initial access. However, we have two different plans. There's the free plan and the paid plan. The free plan, within the free plan, you have access to the basic features of the platform. And then within the paid plan, you have access to the fundraising features. And in addition to that, we have a 30-day free trial for the paid plan. So before you begin to make payment for the paid plan, you have access to the features for 30 days. And once the 30 days are over, you need to make payment to continue to use the features. I hope that answered your question.
Yeah, to add on to what Ozzy is saying, so for the paid plan, we charge a subscription fee of $50 per month. And then we've mentioned on this call that we do provide valuation services. So for that, we charge a fee of $100. And this is a one-time fee.
All right, everyone. Okay, thanks. So thank you once again. I'm happy we were able to answer questions. At this point, we'd like to call it a day. See you at our next quarter's workshop. And we also look forward to you signing up and enjoying these benefits that Sam and Uzi had talked about. Enjoy the rest of the day. Thank you. Bye.
Thank you, everyone. Bye.
Thank you for your time. Have a lovely day. We're happy it was impactful, Vinod. Thanks for joining.